The motorcycle market is collapsing, dealers shutting down, factories cutting production, and repossessions flooding auctions. Riders are walking away and values are crumbling fast. This isn't just another downturn, it's the biggest shakeup in decades. Watch until the very end because what's happening next could change the future of riding forever. Unsold iron. It is a scene few in the motorcycle industry thought they would ever witness. Showrooms, once alive with the hum of conversation and the scent of new leather, now echo with silence. The rows of gleaming chrome and polished paint have become monuments to stalled demand, with more than 60,000 brand-new motorcycles sitting unsold across the country. These machines are not weeks old. Some have been languishing for nearly 300 days, quietly gathering dust under showroom lights that seem too bright for such stillness. Salespeople lean on counters with nothing to do, scrolling their phones, glancing toward the door that rarely opens. Managers speak in hushed tones about strategic adjustments, but the truth is plain. Customers have vanished. Foot traffic is down, online inquiries have cratered, and even deep discounts, zero-down offers, and bundled accessory packages fail to tempt buyers inside. A dealership that once moved a dozen bikes a week now celebrates if they sell 2 in a month. From Harley-Davidson to Honda, from Yamaha to Ducati, no brand is immune. The entry-level models that once sold before the ink on the invoice was dry now sit alongside luxury touring bikes in an unbroken line of unsold metal. It is more than inventory. It is capital locked in place, floor plan loans accruing interest while the value of each bike quietly declines. Dealers are discovering that even slashing prices cannot turn the tide when the core problem is that buyers simply do not want or cannot afford what is on offer. From silent showrooms to shuttered storefronts, the damage was spreading faster than anyone could contain it. The vanishing footprint. In towns across America, the disappearance of motorcycle dealerships is leaving gaps that cannot be filled. On average, one dealership closes every 2 days, a pace that feels less like a trend and more like a countdown. The closures are not limited to struggling mom-and-pop shops. Massive multi-brand superstores with decades of history are shuttering as well. These are places that have sold bikes to 3 generations of the same family, now standing dark behind locked glass doors. When a dealership closes, it is not only the loss of a showroom, it is the loss of a gathering place. Weekend rides that began and ended in the dealer's parking lot fade away. Local mechanics lose steady work, coffee shops and diners near the store see fewer customers, and regional motorcycle clubs lose a central hub. For many small cities, the dealership was a cultural anchor as much as a business. The reasons behind the closures are stark. Inventory costs have ballooned, rent and insurance climb every year, and wages must keep pace with inflation. In good times, steady sales covered these expenses. In the current climate, the math no longer works. With sales revenue plunging, dealers are forced to make impossible decisions. Drain personal savings to keep the lights on, slash staff hours, or close entirely. Those who hang on are cutting everything non-essential. Service bays run with skeleton crews, event sponsorships disappear, and marketing budgets are slashed to the bone. But for many, the struggle to hold on will not last much longer. With sales floors going dark, the shockwaves were about to hit the assembly lines in brutal fashion. If you've made it this far, you clearly see how big this crash really is. Hit that like button so more riders and investors hear the warning, and drop a comment with what's happening in your area. Your insight might help someone avoid a costly mistake. Assembly lines on ice. Inside the factories, the air has changed. Where the clanging of tools and the steady hum of conveyor belts once set the rhythm of the day, now there are long pauses, empty shifts, and entire sections of the floor gone quiet. Harley-Davidson has idled 2 production lines and reduced output by more than 1/3 for the quarter. Honda has scaled back shipments to the United States by 20%, and other manufacturers are quietly making similar moves. For the workers, the cuts are more than statistics. They mean shorter work weeks, uncertain paychecks, and the constant worry of layoffs. The supply chain feels the pain just as sharply. Parts suppliers, transport companies, and contract laborers are all watching orders shrink and deadlines vanish. Trucks that used to haul loads of finished motorcycles to dealerships now sit idle, their drivers reassigned or laid off. These production cuts are not temporary pauses to clear a minor backlog. They are deliberate moves to slow the flow of new motorcycles into a market that is already drowning in them. Manufacturers overbuilt during the pandemic boom years, expecting growth to continue indefinitely. Now, with demand collapsing, they are left with too much capacity and too few buyers. The factories may still hold the machines and tools to build thousands of bikes a week, but without a market to sell to, they might as well be museums. The factories slowed, but the sticker prices still climbed, and that became the next breaking point. Looking for the right accessories without overspending? We've prepared a complete list of smart choices. Check the description. Price shock. Over the past 5 years, the cost of a new motorcycle has risen more than 40%. That increase is not limited to high-end touring machines. Even entry-level bikes that once served as affordable gateways into riding have crept into 5-figure territory after dealer fees. A Yamaha MT-07 now pushes $9,000 to $10,000 before factoring in taxes, registration, and insurance. A Harley-Davidson Road Glide can easily top $30,000, while a BMW GS Adventure starts closer to $25,000 and climbs from there. The sticker price is only the beginning. Financing charges have surged alongside interest rates, pushing monthly payments into territory that rivals car loans. Add in mandatory insurance, maintenance, and basic riding gear, and the monthly cost of ownership can easily land between $700 and $800. For many potential buyers, that is more than rent or a mortgage payment. In an era where wages have not kept pace with inflation, such costs are impossible to justify for what is, for most riders, a recreational vehicle. Younger generations already facing student loan payments, high housing costs, and rising everyday expenses see motorcycles as a luxury, not a necessity. Even older riders, traditionally more willing to spend, are balking at the numbers when they compare the cost to the limited months of riding weather in much of the country. This affordability gap is not just reducing demand, it is rewriting the very definition of the motorcycle market. While riders balked at the price tags, another quieter crisis was tightening its grip on the industry's throat. Loan denied. The door to motorcycle financing is slamming shut, and for many potential buyers, there is no way around it. Banks and credit unions that once competed for motorcycle loan customers have reclassified these loans as high-risk assets. This shift has not been gradual. It has been abrupt and unforgiving. In 2020, a buyer with good credit could expect an interest rate in the low single digits. Now that same buyer is being quoted rates between 9 and 11% for a new motorcycle and even higher for used. The reasoning from lenders is cold but clear. They point to rising default rates, rapid depreciation, and a shrinking pool of qualified buyers. In their models, motorcycles no longer resemble stable, manageable consumer loans. They look more like speculative purchases prone to quick value loss. Every repossession feeds their caution, reinforcing the data that tells them to pull back. For the would-be rider, this means even those with strong credit scores and steady incomes are facing either unaffordable monthly payments or outright rejection. The denial is not personal. It is policy, applied uniformly to protect the institution. But to the consumer standing in the showroom, it feels like a door being closed in their face. The credit freeze is creating a deeper problem. Without financing, even those willing to tolerate today's inflated prices cannot make the numbers work. As credit doors slammed shut, the last dependable group of buyers began to vanish too. The empty wallet effect. For decades, cash buyers were the safety valve of the motorcycle market. They represented stability in times of tightening credit, swooping in to close deals without the approval of a lender. Today, even that lifeline is fraying. Inflation has eaten into savings across all income brackets, and the uncertainty of the broader economy has made those with cash far less willing to part with it. The change is visible on dealership floors. Where once a cash buyer might have walked in ready to purchase, now they browse and leave empty-handed, citing a desire to wait and see. Rising housing costs, medical bills, and day-to-day expenses are competing directly with the idea of spending five figures on a discretionary purchase. Even those who could comfortably afford a new bike are holding back, betting that the market will get worse before it gets better, and that patience will pay off in bigger discounts down the line. This mindset shift is particularly damaging because cash buyers often purchased higher-end models, providing dealers with valuable profit margins. Without them, dealers are left chasing a shrinking pool of finance customers, many of whom are struggling to qualify under today's stricter lending criteria. The loss of cash buyers is not just about missing sales, it is about losing a market segment that was once a stabilizing force in downturns. With fewer willing or able to buy, a flood of repossessions set the stage for an even bigger collapse. Auction flood. The repossession wave is cresting and the market is being pulled under. Repossessions are up 31% year over year, the highest spike since the 2008 financial crisis. Once repossessed, these motorcycles are sent to auction, where they are often sold for 40 to 50% below their original retail value. This torrent of discounted machines is undermining the entire pricing structure of the market. For a buyer scanning auction listings, it makes little sense to pay dealership prices when nearly new bikes can be had for thousands less. Dealers know this, and many have stopped taking trade-ins altogether because they cannot resell them without losing money. Private sellers fare no better, encountering aggressive lowball offers and long waits for serious interest. The damage is cyclical. Falling used bike prices make new bikes appear even more overpriced by comparison, reducing demand for fresh inventory. That lack of demand leads to more unsold stock at dealerships, which in turn leads to more repossessions as current owners walk away from loans they cannot justify. It is a feedback loop with no clear exit, and every month the problem compounds. Amid the chaos of the used market freefall, a corporate battle at one of the most famous names in motorcycling was about to erupt. Boardroom crossfire. At Harley-Davidson's headquarters, the crisis has spilled into the boardroom. A proxy fight has erupted between activist investor H Partners and the company's existing leadership over the brand's direction. The activist group, rallying behind the slogan "Free the Eagle," is pressing for changes they argue are essential to Harley's survival. The dispute is not merely about financial performance, it is about culture, identity, and the willingness to adapt in a rapidly changing market. H Partners has criticized what they see as a slow and insular response to the downturn, while the current board defends its strategy as deliberate and protective of Harley's long-term brand value. The tension has been heightened by dealer closures, declining sales, and the perception that leadership is out of touch with both the riding community and the realities of the current economy. For shareholders, the stakes are enormous. The outcome of this power struggle could determine whether Harley-Davidson emerges from the crisis as a leaner, more competitive player, or whether it becomes another casualty of an industry in freefall. Employees, dealers, and customers alike are watching closely, knowing that boardroom decisions made now will ripple down to every level of the company. That boardroom clash was only the start. Soon, survival would hinge on moves bold enough to rewrite the playbook. The $5 billion lifeline. In a move that startled both Wall Street and Main Street, Harley-Davidson Financial Services announced the sale of $5 billion in loan receivables to investment giants KKR and PIMCO. On paper, this transaction looked like a clean transfer of debt portfolios, but inside the industry it was seen for what it was: an emergency infusion of liquidity. By offloading these receivables, Harley freed up $1.25 billion in immediate capital. This was not cash to chase new growth, it was oxygen to keep the lights on during the industry's most suffocating downturn in decades. The mechanics were straightforward. Harley had extended loans to its customers through its financial arm, HDFS, and those loans represented a steady trickle of repayments over time. By selling them to outside investors, Harley traded long-term income for short-term survival capital. The injection of funds gave the company breathing room to manage inventory backlogs, shore up dealer support, and reassure nervous shareholders that bankruptcy was not on the horizon. Investors rewarded the move instantly. Shares surged more than 15% in the days after the announcement, a sharp contrast to the gloomy mood that had hung over the brand for much of the year. But financial engineering is a stopgap, not a cure. The company now had cash, but the structural problems of collapsing demand, shrinking demographics, and industry-wide oversupply remained untouched. The cash infusion kept the lights on, but a change in leadership promised to shake the brand's very identity. New helm at Harley. On the 1st of October, Harley-Davidson will hand the keys to its executive suite to Artie Starrs, a man whose resume reads more like that of a hospitality executive than a motorcycle mogul. Starrs built his career leading Topgolf and Pizza Hut, brands known for entertainment and fast service, not for navigating the intricacies of a heritage motorcycle manufacturer. His appointment was both a bold statement and a gamble. For supporters, Starrs represents fresh thinking at a time when Harley desperately needs it. His track record in brand reinvention and customer engagement could translate into new approaches for attracting younger riders and broadening the company's appeal beyond its aging core. In theory, his outsider perspective might help Harley break free from its insular corporate culture and challenge long-standing assumptions about what a motorcycle company should be. For critics, the move signals desperation. Leading a leisure brand is one thing. Leading a motorcycle icon through its worst economic storm in half a century is another entirely. Starrs will be tasked with winning over skeptical dealers, cautious investors, and a fiercely loyal but change-resistant rider base, all while implementing strategies that must deliver results quickly. While Harley gambled on fresh blood, one European rival was proving that swift, ruthless change could actually work. KTM's sharp turn. In Austria, KTM has pulled off the kind of turnaround that many thought impossible in this climate. Just a year earlier, the company was buried under 1.64 billion euros in debt, its balance sheet straining under years of aggressive expansion. By mid-2025, KTM had slashed that debt to just over 756 million euros and posted an operating profit of 931 million euros. The transformation was not magic, it was discipline. KTM aggressively cut costs, streamlined its product lineup, and renegotiated supplier contracts to reflect the reality of slower sales. The company also doubled down on models with consistent demand rather than chasing every niche in the market. In doing so, it avoided the inventory pileups that were strangling other brands. KTM's restructuring is now being studied by industry analysts as a possible blueprint for survival. It shows that drastic early action can stabilize a company even in a hostile market. However, it also underscores how rare such turnarounds are. Few companies have the financial flexibility, brand positioning, and management willpower to execute such sweeping changes before crisis turns into collapse. KTM's revival stood in sharp contrast to the devastation unfolding across the globe. Global shockwaves. In Australia, the Peter Stevens Dealership Group, a household name among riders, entered administration, sending shockwaves through the nation's motorcycle community. The group, which once operated multiple large-format stores in prime locations, saw creditors lining up for more than 65 million Australian dollars in claims. Two major stores in Geelong and Ringwood shut their doors entirely, leaving employees and customers scrambling for answers. The collapse was the result of the same forces battering the industry worldwide: unsold inventory, rising operating costs, and a customer base shrinking faster than new riders could replace it. For staff, the announcement came with a mixture of relief and uncertainty. Some 250 jobs were initially retained under new ownership arrangements, but the future remains fragile. Customers with deposits on bikes or service work in progress were left in limbo, relying on administrators to sort through the mess. Peter Stevens' downfall is a cautionary tale for other dealership networks across the globe. It shows that even market leaders with strong brand recognition are vulnerable when industry fundamentals turn against them. As in the United States, the loss of a major dealership group has ripple effects. Suppliers lose a buyer, communities lose a hub, and manufacturers lose a key retail partner. With the crisis now global, the question shifted from immediate survival to what the industry's future might even look like. The vanishing rider. The motorcycle industry is facing a demographic shift it can no longer ignore. Baby boomers, who once formed the backbone of motorcycle sales, are aging out of riding. For decades, this generation kept dealerships busy and manufacturers profitable, buying everything from touring bikes to high-powered cruisers. But now, many are selling their bikes, hanging up their helmets, or simply stepping away from the lifestyle for health and safety reasons. Their departure leaves a hole that the next generations are not rushing to fill. Millennials and members of Generation Z view motorcycles through a different lens. Where older riders saw freedom, rebellion, and independence, younger people often see an expensive hobby with high barriers to entry. Licensing processes can be complicated, insurance costs are steep, and safe storage is a challenge for those living in urban areas. In a time when housing, education, and everyday living expenses consume a large share of income, a motorcycle is often the last thing on a young person's list. Culturally, the image of the motorcycle has shifted. It is no longer a universal symbol of adventure. Competing forms of mobility, from ride-share services to e-bikes, have given younger generations more practical options. Without a strong pipeline of new riders, the industry risks shrinking into a niche market, serving only enthusiasts rather than the broader public. As the rider base thinned, the competitive field was about to be cut down just as mercilessly. Survival of the few. With fewer riders in the market, the motorcycle industry is entering an era of consolidation. Too many brands are competing for too few customers, and the economics no longer support such a crowded field. Mergers, acquisitions, and outright shutdowns are becoming inevitable. Smaller manufacturers without the financial reserves to weather prolonged low sales are the most vulnerable. Industry analysts predict that within a few years, the number of major motorcycle brands could drop significantly. Well-known names that have been part of the riding landscape for decades may disappear entirely or be absorbed into larger companies. Even among the big players, survival will depend on adapting product lines, streamlining operations, and shedding unprofitable models. For consumers, consolidation means fewer choices on the showroom floor and a greater concentration of market power in the hands of a few dominant manufacturers. For dealers, it means relying on fewer suppliers, which can increase risk if those suppliers stumble. And for the industry as a whole, it means a loss of the diversity that once allowed it to appeal to a wide range of riders. Once the dust of consolidation settled, a new kind of machine began to rise in its place. Practical over prestige, the shift in rider preferences is already visible in sales trends. Expensive lifestyle motorcycles, once the pride of manufacturers' catalogs, are giving way to smaller, more practical machines. Scooters, basic commuter bikes, and low-maintenance utilitarian models are on the rise. These are not the machines of glossy magazine covers. They are built for affordability, reliability, and ease of use. Urban riders value compact size, fuel efficiency, and low insurance costs. Younger buyers, when they do enter the market, are more likely to choose a versatile scooter that can navigate city traffic than a heavyweight cruiser designed for long highway rides. Electric scooters and small displacement motorcycles are also gaining traction, appealing to those who want an environmentally friendly and cost-conscious alternative to cars. Manufacturers that pivot toward these needs are finding pockets of growth even in the downturn. Brands offering entry-level models with accessible pricing and low operating costs are building a foothold among riders who might otherwise skip motorcycle ownership entirely. The shift away from prestige-driven marketing toward practical value is not just a temporary response to economic pressures, it is a long-term repositioning of what the motorcycle means in daily life. Practicality was winning the cultural war, but for buyers and investors, timing would be everything. We're heading into a motorcycle market unlike anything we've seen before. If you want to stay ahead of the shifts, hit subscribe right now. The next update could be the one that helps you save thousands, or spot the opportunity everyone else is too late to catch. Your wallet, your move. For consumers, the motorcycle crash presents both risk and opportunity. The risk lies in buying too soon and watching values continue to fall. With repossessed bikes flooding auctions and dealerships sitting on inventory for months, prices are likely to keep dropping in the near term. The opportunity lies in patience, waiting until desperate dealers slash prices further to clear space before the next model year. Those who can wait may find deals that would have been unthinkable just a few years ago. For current owners, the message is the opposite. Sell sooner rather than later. Every month of delay risks further depreciation as the market adjusts downward. In some cases, selling now, even at a loss, could save thousands compared to holding on through another year of falling prices. Investors face a different calculation. Brands that embrace affordability, streamline production, and target emerging market segments stand to gain once the industry stabilizes. Companies stuck in outdated strategies or clinging to prestige pricing may not survive the shakeout. For those willing to take a long-term view, now is the time to identify which manufacturers are positioned for growth in a leaner, more practical market. The motorcycle industry that emerges from this collapse will not look like the one that entered it. Smaller, more focused, and more attuned to value than prestige, it will serve a different kind of rider. The question for everyone, whether buyer, seller, or investor, is not if the change is coming, but whether you are ready for the ride ahead. The motorcycle market is rewriting itself in real time, and missing the next move could cost you big. Subscribe now, turn on notifications, and stay ahead of the curve. Share this video with someone who needs the warning, because the deals and the dangers are only just getting started.